Thank you. Welcome to the Property Investor Show. This is my second panel. This one I think is particularly important. I guess look, the Property Investor Show means that a large number of the people that are here are either landlords, property investors, or want to be. And what we're going to be talking about on this panel, hello again, is the very important question of what happens next. What happens in 2024? All to play for, I guess. You know, we've got a very questionable property market, which we'll be talking about. Lots of different views, whether it be optimists or pessimists. I'm just talking to a guy that used to be an optimist, Paul here, who's now turned pessimist in the last 24 hours. Maybe we'll talk about that in a second. But look, we'll be talking about our sentiments, numbers. We've got Richard Donnell here from Zoopla, who is Mr. Numbers when it comes to the property market, if he doesn't mind me saying. No pressure, Richard. So let's get into what next year looks like, particularly, of course, against a backdrop of what is inevitably going to be a general election. That will have all sorts of implications, not just in terms of who gets in, and I think we can all guess at the moment that it might not be Rishi Sunak and his mob next time. However, the run-up to that, so the next 12 months as parties start to electioneer, is going to cause, I think, a lot of confusion and a bit of mayhem on the basis of what is policy changing and so on. So I think there's going to be a very interesting year. The question is, will it be a good one or not? So I'd like to start, if I may, just with a bit of an audience poll. Hands up anybody here that as a landlord or an investor in the round, so I'm not just talking about house prices, but generally, hands up here that who's an optimist about next year as a landlord or an investor. Well, a few hands have gone up. I think that's about a third of the room, would we say? So does that mean that 2/3 are pessimistic about next year, or are you a lot of don't knows? Who doesn't know? Okay, wow, I think that's more than the more than the first group. Okay, all right, well, look, let's get into it. And what I'd like to do, I'll introduce the panel, of course, in a minute, and myself. I really like these panels to be interactive, because it's not just about a talking shop amongst the property heads here. We can do that and do all the time, whether it's face-to-face, in the pub, on WhatsApp groups, in social media. This is about you and what you think. And so therefore, if there are questions that you have, if there are comments, whatever you want to say about the property market and how you think it shapes up next year for landlords and investors in particular, let us know. So let's have a very interactive and engaging hour or so. Right, so intros. I'm Russell Quirk. I'm a bit of a property guy, I suppose. I've been an estate agent on and off for many, many years. I've been involved in the public sector where I've chaired council planning committees. I've built a few houses. I'm a very, very amateur landlord, and I do a bit of property commentary on the likes of, I'll say this very quietly, GB News, Talk TV, BBC, Sky, and so on, as do most of these guys, actually, particularly Richard and Richard. So let's introduce the first member of the panel, Richard Blanco, who I'm sure you all know, most of you, because he's been on most of these panels over the life of the Property Investor Show, Richard.
Yes, hello everyone. I'm Richard Blanco. I'm one of the London representatives for the National Residential Landlords Association. I'm also a landlord. I've got properties across 6 London boroughs, and I, in the past, have bought at auction, so very interested in buying at auction, although I haven't bought for some time.
Have you not bought anything for some time?
No, not since 2019, actually.
We'll get back to that. Interesting. Right, okay, Adam.
Hello everyone, I'm Adam Lawrence. I chair an investment group which has done over 500 deals that we've held on to. Generally speaking, lower value buy-to-lets, so not London focused, but very much Midlands and the provinces, Scotland and Wales, and have been, for my sins, a qualified agent in all of those locations.
Great, thank you. And Richard, can I say a property academic, really, aren't you?
I'm just a housing market analyst. Been at
Just?
it for 25 years or so. Started at Savills, had some kind of good home track, which was all about data, and then joined the Zoopla group, which now rebranded to Houseful. I'm just very lucky. I have so many numbers to play with, and spent a lot of time chatting to government, house builders, estate agents, banks, and others. And I'm fascinated to hear what you guys at the coalface think, as well as hearing and giving you my views.
Okay. So, Richard, should we start with you in terms of the current state of the markets? Obviously, you have lots and lots of very regular and consistent numbers around the housing market. Do you want to kind of bring us up to date where you see it from Zoopla's point of view in terms of both rent and rent growth this year and house prices and house price growth? Where are we?
We're just two totally different markets, aren't there? The sales market and the lettings market. Huge slowdown in the housing market. Doesn't matter which index you look at, prices are sort of falling somewhere between 1% and 5% year on year. it's confounded a lot of people last year who thought the wheels were going to literally fall off and we'd have a huge house price crash. There's a number of reasons for that. A lot of it's to do with mortgage regulation and tighter lending controls has meant there's not been a big housing collapse. I don't think there will be one. But housing still looks unaffordable, house prices. So I think we've got probably prices going sideways for a couple more years as incomes catch up and make things a bit more affordable. So
But no big drops.
no big drops, but it's it's a tricky environment. But there are people who want to sell, and there's people who want to buy. It's just about being reasonable if you're a seller. So the sales market is faring well, but volumes are down 23% year on year. I think volumes are going to hold about 1 million when they normally trade at about 1.2 over the long run. So, and then the lettings market is just red hot, as you all know. We've seen a sort of the private rented sector has not grown in size since 2016. 5.5 million homes, 5.5 billion homes. That means people selling up are offsetting people investing. There's a lot of corporate investors, and there are still people buying properties. So rental market supply is flat, and then we've had record demand. We've had demand from record immigration, strong labour market, record student numbers, not enough purpose-built student accommodations, a huge amount of demand against a market that's not really growing. And we've got a third fewer homes for rent on Zoopla than we'd see before the pandemic. No choice. Rightmove yesterday.
Sorry, Richard, so just to clarify, available rental stock is down 35%.
The number of homes and estate agents listing on Zoopla per branch is a third lower than it would be before the
And
pandemic.
demand is higher.
And demand is, well, we think there's 35 people chasing every rented property. Rightmove
As
said
opposed to
25.
pre-2019.
Oh, so
Well, your
10,
competitors
9
came
or
out with some
10,
numbers.
9 or
next week.
10.
9 or 10, right.
And so therefore rents are rocketing.
Up by how much?
About
9%?
They've been in double digits for 18 months, so running about 10% year on year. That's for new lets.
Yeah.
The ONS index, if you see it, tracks what's happened to rents for all 5.5 million rented homes. People like us, other competitors and others, we track new lets, so a vacant property to a vacant property. But if you go to Scotland, where rent controls are, landlords are driving rents up really hard to get ahead of the rent controls in Scotland. You're limited during a tenancy to only increasing the rent by 3% a year. So in Edinburgh, rents are up 16% in the last year, Manchester up 14%. So yeah, rental growth is strong, but I think we're going to run out of road on affordability of renting is going to slow rental growth. We can't.
Even though wage growth is pretty high, I mean, wage growth is still about 7%, which is almost at record numbers.
Sustainable rental growth is in line with earnings. Rents track earnings over the long run. There's a 20-year relationship, and that's why everyone should invest in residential property, because if you're a pensioner and you want your cash flow to rise in line with earnings, I mean, why not invest in residential?
And that, ladies and gentlemen, is probably all you need to know. That's it. So it sounds, Richard, and Adam maybe you might want to answer this more specifically. It sounds like, in answer to our question, is 2024 the year for investors and landlords in the property market? It sounds like, from what Richard's saying, on the basis that if you're not going to exit the market, as in you're not going to sell your stock, your portfolio, you're not going to be exposed to that 1 to 5% loss, albeit you might have, or you inevitably will have, an increased cost in terms of your buy-to-let mortgage rate. However, with rents, as Richard's saying, up at kind of 10% plus year on year, it really is a great time to be a landlord next year, isn't it?
Well, I think I'm going to just first of all try and add something, possibly suicidally, to what Richard's just said.
You're going to disagree, because our last panel, they were almost hitting each other.
I agree with 90+% of what he said, but in terms of affordability, I've actually done some analysis that goes back to 2005, which is the first year that the ONS hold figures for rents. And you might be surprised to know that the latest month we can get up to, which is May 23 at the moment, rent is over 15% cheaper compared to wages than it was in 2005. Now, that's on a national level. So I think there's a lot of rope left in the affordability ceiling, actually. And now, of course, that depends where you are. If your properties are in zone 1, I don't think there is much rope, because I think people are already crammed into the smallest spaces they can be, and already you get 3 people who have to share a 1-bedroom flat. However, in the provinces, I think there's plenty of affordability rope, and I think we could go another 25% plus on rents without seeing too much squeeze in affordability.
I agree with it. I think it's really, I think it's London, the South East, where we're going to really hit the affordability limits.
Where it's being stretched
the buffers. And the double bubble in there, of course, is with the rates where they are, new purchases struggle to stack up, because the yields just aren't as high. The properties are more expensive because of where it is in the country, the yields aren't as high.
Richard Blanco, you told us just now that you haven't bought a property since 2019, so you must be a bit of a pessimist. Otherwise, you'd be rushing to buy and increase the size of your portfolio, wouldn't you?
I am a bit of a pessimist. I mean, our stats tell us that 37% of landlords are thinking of selling some or all of their properties in the next 12 months.
Thinking of selling. So I always have an
Yes.
issue with this because you ask landlords, they're always morose. They're always, it's terrible, it's awful. But do they actually then
Well, I
sell?
can tell you the actual figures. In the last quarter, 12% actually sold and 5% actually bought. So at the moment, 37% are telling us that they're thinking of selling and 8% are telling us that they're thinking of buying. So I think the main thing to take from that is there's a big gap. So, we're not going to be meeting that huge demand soon. And
Can we just ask the room? So in the room, of all of the landlords in the room, so those that own property right now, how many are seriously, I know the first hand is going to go up, how many are seriously thinking of selling right now?
Only if you're pressured by the interest rates.
What do you think interest rates need to get to for that pressure to bear so much that you sell?
6, 7.
Which I don't think is going to happen. Inflation under control-ish. Bank of England didn't increase rates when they had the opportunity to 2 weeks ago.
Wait till Labour gets in.
Well, we'll come to that, sir. We will come to that. So not many pessimists in the room. Hardly anybody put their hand up. Louise, are you saying?
I'm linked into a fixed rate mortgage, so I can't sell, but I wanted to.
You wanted to. When did you buy your property?
Well, I've just developed it, so the time wasn't right to sell it
Yeah,
at that stage.
because there's of course another argument to all of this, that it's all very well us talking about the numbers as we do now. So house prices at £286,000, rents on average, I don't know what Zoopla is saying, but 1,100 and something,
Yeah, 1,200.
£1,200. But what about the landlord that bought most of their properties 10 years ago, where your stand-in value, if you like, is much, much lower? I think there are different
But then they
dynamics.
would have done equity release and then the
Maybe.
yeah.
Or to buy other properties that have also gone up in value. Let's not forget, house prices have gone up in value by about 20% since just before the pandemic. So even if house prices drop by 3 or 4 or 5%, as Richard's saying, you're still ahead of the game.
I think there's definitely an element of the generation of landlords that bought in the 1990s and the 2000s starting to sell up now. So I think that's feeding into the sell-off.
But it's not reflected in the room here, Richard.
Well, our research tells us that we think we could lose up to 7% of the private rental sector if interest rates stay at this level for a couple of years. So, and I think what's happening is, because only 15% of people have variable rate mortgages, we know it's around 1.5 that are coming off fixed rates this year. That shock from below 2% to above 5 or 6% hasn't hit a lot of people still. I mean, I've got 5 mortgages that have gone from 1.25 to one's about to go to 5.6, and my mortgages are doubling, tripling, quadrupling, and I think as that
You've got
starts,
massive equity cover in those properties.
I have, but I'm still having to put savings into my property business every month.
Right,
From
because
now
you're
on.
losing on a monthly basis.
Yes,
The difference between
my,
the mortgage
my
repayment.
profitability has gone, and and it won't come back until interest rates are back down to 3.5%.
But what about switching to interest only
They're all interest only.
already?
Yes, yeah. So what I see is a very difficult 18 months, but I do see light at the end of the tunnel. I put my hand up and said I'm an optimist for next year because I hope that the what I'm predicting is that the May Bank of England MPC meeting next year will be the first cut in interest rates. I'm hoping it'll be a bit earlier than perhaps other people think. So that's why I'm going for trackers at the moment, and I'm hoping to ride down with the base rate next year.
Okay. Sorry, the gentleman who's just sat at the end here is someone that's known to me. Don't worry, he hasn't just come and hijacked the table. This is James Forrester, who runs 2 businesses actually, Barrows and Forrester, which is an estate and letting agent in the West Midlands, but also a student accommodation developer in the North East. James, welcome. So thanks for popping in. Have you got the gist of the conversation?
Yes,
Optimist or pessimist for next year?
landlords have never had it better.
Ooh,
Nice one.
I'm very controversial as well.
never had it better.
He's from
Wow.
the north, obviously.
Well, and again, is there a north-south divide? I mean, Richard, you see north-south divide in your numbers?
I think so. I think the cash flow, because I think for me we're just in the middle of a transition in the rental market from exactly as you say, buy-to-let mortgages, retail mortgages at cheap rates came available in 1998. The private rental sector doubled in size by 2016, and then all the tax changes happened. And so basically, we're moving from a load of people who probably got into it by accident, but were accumulating huge gains. Mortgage rates were falling. It was a no-brainer. You didn't have to think that hard being an investor. And now, all of a sudden, it's turned into a business. And the shakeout is people who actually aren't really up for it as a business. But if you're in it as a business, and you love cash flow, it's pretty attractive and exciting. And I think
Richard Blanco
Oh,
is shaking
no,
his head
no,
at me.
I mean,
Richard Donald, go on.
I've just been talking to somebody who is his tax bill is higher than his profits, and he's literally going bankrupt.
Yeah, but
He's
I think-
got
I think-
27 properties in Hertfacre,
I-
and that's a business. It's not.
No,
you
I
know,
get it, but I
and
think
was a
also
tiny business.
what I should say is a business without tons of leverage. So I was just going to interject on the point
Okay.
here. So
And you
because
know,
I
we
think just to finish the point, I think I think when we looked, 40% of landlords have got no mortgage. About a third of landlords have got a mortgage of less than 50% loan to value.
Okay.
And how many are on
And
fixed rates?
a third are on high loan to value, and I think the people who are I totally hear you, Richard. The people who are being totally squeezed out by higher mortgage rates are people who probably kept refinancing and extracting equity all the way up. And I think the people who
but
are
we're
really
still at below 60% loan to value, which is not
but
that
in the south of
high.
England, to make numbers work, you've got to be
Yes,
sub.
because-
I think
50
the problem is
sub
that it's
40.
not the LTV. You see, it's ultimately the debt service coverage, and there's a big problem
Correct.
with this in the
Yeah,
market
correct.
because the lenders still think that 125% debt service coverage is enough.
Yeah.
And if you use an agent, and especially if you're in more like the North and the Midlands, it's not enough anymore. Price of maintenance is
What-
too
what's
high.
your
price of
point?
My
maintenance is
point
too high.
is, like, I'm an accidental landlord.
One
Uh,
property?
Two.
Two.
So
Two accidents.
Two accidents.
Yes.
That's very careless.
Accident prone.
So before I used to think that, okay, by the time I retire, I will repay that mortgage so that I get the rental income as a pension. But now, because of high interest rate, I may need to sell one property.
But don't we need to look at property investment as a long-term thing
I do
rather
want
than
to.
a microcosm of today? So, Paul, if you don't mind me kind of picking on you, so you've been a landlord for a long time, 25 years, but you've gone from obviously being an optimist, having built and bought a portfolio, to all of a sudden becoming a pessimist. But what about, and we'll talk about the political implications, what's going to happen later on, but what about looking at this over the next 3 years, 5 years? Bit of capital appreciation, maybe, huge increase in rent and therefore yield, particularly if you apply your yield to what you paid for the property rather than actually the value today, notwithstanding things like equity release and so on. I mean, I guess my question is for everybody, is there another asset that we can think of that's better than being a buy-to-let landlord?
Well, I think the problem is that depends on how you ask the question, doesn't it? Because if you're talking about the next 12 months, you might see people say, well, hold on, everybody who's had any experience in the room knows it's not passive income.
Yeah,
right?
but
It's
who
the
would
greatest
invest in
myth in the
property
world.
for 12 months?
Well, but people make decisions in the now. Even the central bank, Russell, are making decisions based on what happened last week, not based on the next 6 and 18 months. That's how much we live in the now these days.
Yeah, but that's interest rate decision. That's capitalisation. That's loan to value cover. But as an investor, there's not many people make decisions on that short term horizon.
Well, I think anybody investing in the stock market, largely speaking, often makes decisions based on the next quarter, and the CEO is managing the stock price for the next
Pension
quarter,
funds,
not.
pretty long term.
Well, it depends, because if they get forced out by the bond yields moving against them,
Yeah.
they put themselves, so things that weren't supposed to happen are happening. So bonds are supposed to be not volatile. They've been extremely volatile.
Yeah.
They had leverage, even pension funds, the whole Liz Truss thing and the leveraged direct investment and all the rest of it all came about where we were all very surprised, those of us who don't work in the city, that pension funds were taking that sort of level of risk with their money. But as the price goes down and the yield goes up of the bond, they're selling more, and it's making the problem even worse. And then you look back historically to times like this in the past, and you end up at places like 1987, which is not really where you want to be from an economic and a stock market perspective, or slumps of the early 90s. I'm not as pessimistic as I've just sounded.
Let's get back to the question of the panel.
I think-
Because obviously we're racing through this.
Differences on the pension companies, they're not buying buy-to-let properties. They're building developments.
They're build to rent.
They're in build-to-rent or purpose-built student accommodation. They'll base their numbers on 5.5% returns over 20 years, and it works for them really,
Plus
really
capital.
well. I think what happens here, and speaking obviously as a letting agent, estate agent, we've seen both models. So Richard's just picked up a good point, but I would disagree on this, because eating into savings, none of us in this room would want to eat into our savings to pay at the moment. But then, how long have you had it for a great time? With all that capital appreciation, all the equity build, it's a bit like you have to run it as a business. And sometimes, like at the moment, you've got to say, I might have to pull some money out and take that hit for the next few years until we start to see interest rates hopefully fall a bit lower. Bank of India are down at 50%, 3.99% on a buy-to-let at the moment. So there is options out there. But sometimes you have to take that business decision to go, we might just have to top this up for a couple of years because you've had it so good for so long. And
Again,
not many
the
people want to
long-term
do that.
play.
It's
Look at
gotta
it
be
over 10
long-term.
years.
Except the tax situation, which is just unfair. You know that.
I
I
don't
agree.
think anyone wants to pay tax.
No, but I think the Section 24 tax arrangements being taxed on your turnover is just unfair.
I agree, but I think you've got to adjust to what businesses have to adjust to the tax landscape that they're in, and I'm sure we'll go on